John, you were talking about the Magnificent Seven earlier. I want to talk about concentration risk. So NVIDIA, for example, earlier this morning, getting caught in the crossfire right after taking a hit last week on the DeepSeek news. I mean, wow, what a whipsaw we've gone from last Monday to now the beginning of this week. Let's talk about that concentration risk in NVIDIA. What are you seeing there?
Well, I mean, the S&P is not a diversified index anymore, that's for sure. 10 stocks make up 40% of the index. There was a reason why it was good to own the Mag 7, which is that they had exceptional earnings growth. But what's happening is that of late, the S&P 493, their earnings on the margin and the rate of change has been incrementally better. So for 2025, analysts are expecting the Mag 7 earnings growth to be in aggregate 20%. Whereas the 493 on aggregate, it's 8%. So a spread of about 12%, let's say. You know, last year, that spread was more like 32% and even wider the year before. So we just think that if the economy is strong, and I know that we're concerned about tariffs, but you know, at the end of the day, we still have a relatively strong U.S. economy. Earnings growth is still relatively strong on aggregate for the S&P. Jobless claims is low. So with that said, as a backdrop, you know, you should rotate your portfolio and rotate into other things besides Mag 7 stocks. So when it was time for us to make that decision about a year and a half ago, we didn't love the options that were available to us. I think equal weight is an entrance into diversifying. The problem equal weight is that if you equal weight the S&P 500 index or the Russell 1000 index, you know, your marginal contribution to risk and return is going to be a lot smaller. So the average stock and the S&P equal weight index is 20 basis points, you know, which basically means if you're selling SPY to buy that equal weight S&P index fund, you know, you're going from like, you're making a big sector size and style bet. So we created ROE, which is an equally weighted fund of 100 high quality stocks. And, you know, our marginal contribution to risk and return is a lot higher. Each stock is 1% weight. And then we match the S&P sector weight. So, you know, as we look forward the next 3 to 5 years, you know, earnings growth will shift. And we just think that those Mag 7 stocks are very expensive right now.
Yeah, obviously a lot of discussion about those Mag 7, and some people feel like maybe they've missed the boat, but it sounds like you've got other options too, and not to worry, especially if the differential gets smaller as the years go on and those earnings growth. I mean, Todd, similarly, you're focusing on quality growth. I mean, not just that growth at any price, which we were okay with for a long time, but maybe not so much anymore. So what funds sort of capture that thesis for you?
Yeah, well, you were showing on the screen RSP, that's the Invesco S&P 500 equal weight ETF. So John was talking about ROE, which is a quality-oriented portfolio. RSP is just those 500 stocks in the S&P 500. If you wanted a more quality growth or quality filter on the S&P 500, Invesco has an S&P 500 quality ETF, SPHQ. If you wanted something that was more quality and growth and additional filters, American Century has an ETF. The ticker is QGRO, QGRO. This is an ETF that's going to filter based on quality and growth characteristics and a few other ones. And you talked about earlier about diversifying away from NVIDIA. If folks want to do that and still have a focus on the artificial intelligence theme overall, there are ETFs to give you exposure to that. And so we think the Robo Global Artificial Intelligence ETF, the ticker is THNQ, is an example of that. Global X has an artificial intelligence ETF, AIQ. There's a number of ways to get diversified exposure to the artificial intelligence theme.
Todd, another important observation from you, I think, the changing of the guard, so to speak, in tracking the full S&P from the long dominant SPY, we hear that all the time, to the VOO. Why is that? Why are you looking at this shift?
Right, so it could happen this week. We could see Vanguard 500 ETF, the ticker is VOO, as you mentioned, have more assets under management than SPY, the Spider S&P 500 ETF. They're both over $600 billion in overall assets. SPY historically has been used more by institutional investors, and Vanguard's 500 ETF VOO has historically been used by more retail and advisors. That's a great sign to us. First of all, it's success and records being broken are made to be broken, but more retail adoption, more advisor adoption of ETFs is going to broaden the universe of investors that are buying ETFs. So we're watching that, even as SPY remains the default product for many institutional investors. It's still the king out there for many institutional-oriented products.